Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked, where we turn tax confusion into confident action. I am David Robson, your resident tax strategist, and today we are tackling a deceptively simple decision that can be very expensive if you get it wrong: choosing your business entity. Sole proprietorship, partnership, S Corporation, C Corporation, and of course the ever-present LLC. Each choice shapes your taxes, your liability, your paperwork, and your long-term wealth. Think of today's episode as a guided tour through the maze, with a few road signs and some gentle humor so you do not trip over a filing deadline. Whether you are launching your first venture or wondering if your current setup is quietly draining cash, this conversation will help you spot opportunities, avoid traps, and build a structure that supports your goals. Grab a cup of coffee and let us save you real money by getting the foundation right. Before we dive into specifics, let us map the terrain. There are 4 tax treatments you can choose from right out of the gate or by election: sole proprietorship, partnership, S Corporation, and C Corporation. An LLC is not a tax type by itself. It is a legal wrapper that can be taxed as any of those, which we will unpack shortly. The entity you choose affects 4 big things. First, liability protection, what personal assets are on the line if something goes wrong. Second, taxation, how profits are taxed, who pays self-employment taxes, and how much flexibility you have with deductions. Third, administration, bookkeeping, payroll, annual filings, and the cost to keep everything compliant. Fourth, your strategic runway, how you raise capital, add owners, or exit. The right answer changes as your business matures. We will cover the trade-offs, and I will flag where do-it-yourself optimism tends to clash with IRS reality. Spoiler, payroll is not a hobby. Let us start with the easiest: the sole proprietorship. If you hang a shingle and start selling without forming anything, congratulations, you are a sole proprietor. For taxes, your business income and expenses live on Schedule C of your individual return. That means one level of tax, but it also means you pay self-employment tax, both sides of Social Security and Medicare, on your net profit, not just your take-home draw. The compliance burden is light. No separate corporate return, no shareholder minutes, no payroll unless you have employees. The trade-off is liability. There is no legal separation between you and the business. If the business is sued or owes money, your personal assets are reachable. Insurance helps, but it is not a shield against every risk. Sole proprietorships make sense for very small, low-risk ventures, testing a concept, or side work where profits are modest. Watch for 2 turning points: when profit consistently exceeds what you would pay yourself as a reasonable wage, and when contracts, leases, or team members increase your exposure. Those are strong signals to explore an LLC with an S Corporation election. When 2 or more people go into business together without electing corporate treatment, you have a partnership by default, often inside an LLC. A partnership files Form 1065 and issues K-1s to the partners, passing through income, deductions, and credits. There is still one level of tax, but compensation mechanics are different. Partners are generally not W-2 employees. They receive allocations of profit and may receive guaranteed payments for services. Much of that income is subject to self-employment tax, depending on your role and the partnership structure. The good news is flexibility. You can customize allocations, admit new partners, and track capital accounts to reflect who has put in money, sweat, or both. The caution is complexity and liability. Without an LLC, each general partner can be on the hook for partnership obligations. Even with an LLC shell, a sloppy operating agreement or poor records can pierce the veil. Partnerships shine for professional practices, and real estate holds where losses, depreciation, and special allocations matter. If you are 2 founders building a fast-growing operating company, run the numbers early on an S Corporation election, because payroll discipline can reduce self-employment taxes while preserving pass-through treatment. Now the LLC. Think of an LLC as a modern legal chassis. It can be owned by one person or many, formed under state law, and it offers limited liability if you respect the formalities. For tax purposes, the IRS does not have a default LLC return. A single-member LLC is disregarded and taxed like a sole proprietorship unless you elect otherwise. A multi-member LLC is taxed as a partnership unless you elect S Corporation or C Corporation status. That flexibility is powerful. You can start simple, then elect S treatment when profits justify payroll and compliance. A word on a common myth: an LLC formed in one state does not automatically protect you everywhere. In my opinion, and this is not legal advice, liability protection depends on doing business properly in each place. If you operate across state lines, register where you have nexus, maintain separate books, sign contracts in the company's name, carry appropriate insurance, and avoid commingling funds. Courts look at behavior more than headlines. Treat the company like a real company. The veil is a shield, not armor. Onto the S Corporation, a favorite for many profitable small businesses. An S Corporation is a tax election for eligible domestic corporations, or LLCs. You still have pass-through taxation. Income flows to shareholders via K-1, but you change how self-employment taxes apply. Owners who work in the business must be paid a reasonable W-2 salary subject to payroll taxes. Distributions of remaining profit are generally not subject to self-employment tax. Example: if your firm nets $200,000 and a market wage for you is $110,000, paying that salary and taking the rest as distributions can cut employment taxes versus a sole proprietor. Caveats: document reasonable compensation, run real payroll, file quarterly reports, and keep clean books. Some states impose S taxes or ignore the election. Health insurance and retirement for owners have special rules. Who benefits most? Service businesses with profits above a fair wage, and LLCs graduating from the startup phase. Who should pause? Companies reinvesting every dollar, multi-state operations with non-conforming states, or owners unwilling to follow formalities. Now, the C Corporation, the entity many folks fear because of double taxation. Here is how it works. The corporation pays its own tax at the corporate rate on profits. When it distributes after-tax earnings as dividends, shareholders pay tax again. That is the double. Sounds harsh, yet C corporations still make sense in specific scenarios. If you plan to raise venture capital, issue multiple classes of stock, or grant stock options broadly, a C corporation is usually required. Certain fringe benefits are easier or more favorable inside a C corporation, particularly for owner-employees at higher income levels. If you intend to reinvest profits for growth and avoid dividends, the second layer may be limited for years. There is also a powerful incentive called Qualified Small Business Stock, or Section 1202. If you meet strict rules, original issuance, C corporation, active business, 5-year holding period, some or all of the gain on sale can be excluded. Drawbacks include potential trapped losses, accumulated earnings tax, if profits pile up without a business reason, and more formal governance. Practical example: a technology company aiming for outside investors and a future sale often chooses C from day one, while a local agency with steady cash flow may not need it. Working in more than one state complicates every entity choice. Nexus rules determine where you owe income tax returns, sales tax, and payroll withholding. S corporations add a wrinkle because not every state conforms to federal S treatment. Some require a separate state election, some impose entity-level taxes or fees, and a few do not recognize the S at all, which can erase expected savings. Partnerships face apportionment and may need to withhold for non-resident partners. Payroll for owner-employees must follow the state where services are performed, not only the state of incorporation. If you operate through an LLC, register as a foreign entity in states where you have activity, salespeople, a warehouse, recurring projects, not just where your mail goes. Keep clean separations, distinct bank accounts, signed contracts in the company name, and minutes or consents for major decisions. When in doubt, model multi-state tax cost before you switch structures. Surprises are expensive, and interest never laughs at your jokes. That is our tour of sole proprietorships, partnerships, S corporations, C corporations, and what an LLC really does. Your entity shapes liability, tax, admin costs, and strategy, and the best choice can change as you grow. If today sparked questions, that is good news. You just found profit. Talk with a qualified tax pro to model scenarios, especially for payroll and multi-state issues. Thanks for listening to Tax Smarts Unlocked. I am David Robson. See you next time. Take care, everyone.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.